Welcome back. The market's still holding below that 11,200 mark, but not falling too much in the last few minutes. Odd. We've seen a vertical decline, but let's see what happens from here on. But this is that part of the show where we answer all your stock and investment-related queries. Mayuresh Joshi of William O'Neill and Rahul Sharma, who's a market strategist at Equity 99 Advisors, join us, both of them, on the show to answer all your queries. Thanks a lot, gentlemen, for joining in. Let's go straight then to our first caller coming in from Chennai, Mr. Selvam. Good afternoon, Mr. Selvam.
Hi, good afternoon. This is Selvam here.
Right. Tell us, sir, what's your query?
Yeah, see, I bought a Bajaj Finserv for 6,200 and I bought 100 shares. Is it good to hold for long term or any suggestions?
All right, Bajaj twins pick of the pack as it comes to the NBFC space. Mayuresh, what do you make of the company, his investment price, and your recommendation?
Afternoon, Mangalam. Again, I think it's a qualitative franchise, no two ways about it. What has transpired in the past few quarters have obviously played out in terms of the moratoriums, in terms of the lockdown pressures, in terms of the increase in provisioning, and the different businesses that get run through Bajaj Finserv itself. So what the management has put through in terms of its guidance of credit growth of around 10% I think strong underwriting skills are mandated specifically in times like these, and this is what exactly the company is up to. And the second element is obviously that the credit costs, because of all the elements that I put forth, will inch higher. If you look at the subsidiary performance, the subsidiary performance has held up pretty well, Mangalam. So if you look at Bajaj Life as an example, Bajaj General Insurance as an example, even Bajaj Finance, I think the kind of liquidity buffers that they have and the expectations of a recovery in the second half, I think that probably puts forth the argument of staying put with the stock. So I think on the sum of total valuations, the core business expected to do reasonably better over a longer period of time. And their subsidiaries as well, even if you account for a 30% holding company discount, still add significant value to the overall business. So yeah, I think if you've got a long-term horizon, hold would be my recommendation.
Okay, the next query comes in from Michael Lobo, and he's on the line with us from Goa. Hi, Michael.
Yeah, guys, how are you guys doing?
We're doing good. How are you doing?
Nice to see you all at the studio once again.
Well, I'm sure we'd be better off if we were in Goa too. Go ahead. How can we help you?
Yeah, I have to query on SBI cards and HDFC Life. Actually, I just want to know if these two stocks are good buys from a 10-year perspective, and whether at the current levels they are too expensive or they're okay to buy them at this moment.
Okay, so you want to begin a fresh investment, right?
Yes.
Okay, and Michael, I'm so happy to hear you say 10 years because almost nobody who calls up has a long-term horizon. But Mayuresh, for somebody who's looking at a decade, what would you think of stocks like HDFC Life and SBI cards? I mean, certainly a lot of potential lined up, right, over the next 10 years.
Oh, absolutely. And you're absolutely right, Sumer. I think very few callers or very few investors ask for that amount of a time horizon. So it makes life easier to recommend as well. So yeah, I think both the companies, again, qualitative companies within their own spaces. HDFC Life, the general insurance business has probably seen a decline in terms of both annualized premium equivalent growth, whether it's the individual business or group protection that we're probably looking at. And they're also trying to tweak their product mix. Therefore, I think the value of new business margins, which is an extremely critical and integral component for life insurance companies, that has come a tad bit to 24.3% odd. But that should normalize going forward in the next few quarters to around 25-26% odd as well. And the growth should also probably normalize with a lot of participating and the protection mix, along with the bank assurance channel, which has increased significantly, reducing the costs. So the overall cost should stay around 14-15% odd, including commissions, which should rev up the revenue per or the embedded value or the return on embedded value. So yes, valuation's always on the higher side for HDFC Life, but it's a qualitative franchise, so you can probably start the SIP as the stock pushes through or increases in price. For SBI cards, again, I think the moratoriums, the expectations in terms of what might happen in terms of asset quality pressures. I think that clearly played out during the fall. But what you've probably seen as a respite is that the number of card issuances have gone up. The GNPAs have come down to 1.35. The cost income ratio at 47 has come down. And the capital adequacy at 20.1 and provisioning at 67% stays put. The spends per card have increased, which is a positive sign as well. So it's a healthy franchise backed by a healthy parent as well. So in my opinion, yes, both the stocks probably look good. So anything on pullbacks for SBI cards and something in terms of a price rise for HDFC Life, because there is a lot of supply in the next 30, 40 odd rupees for HDFC Life. But start a SIP, I think that's the best way to go.
Yes, Bank. The next query comes in from West Bengal. Mr. Kush Jingan writes to us, holds 27 shares of Jubilant Foodworks. The price mentioned is 27. I believe that is incorrect. We'll have to probably fix the price itself, because the quantity is 27, not the price. So we'll just take that off. But nevertheless, we'll go ahead and ask Mayuresh about his views on the stock. Mayuresh, almost a 70% rally is what we've seen from the lows on Jubilant Foodworks. The fact that they introduced delivery charges should do well for their margins. And now there is IPL as well. So a lot of people eating pizza perhaps.
Yeah. Well, you're absolutely right, Mangalam, and I think you're a better judge of this. So Blitzkrieg is Mangalam, which puts his tweets on Twitter on HUL and other FMCG companies, is a master on this. However, I think what has happened with Jubilant, and you're absolutely right, I think the same sales stores growth is something to be monitored over a longer period of time. And they were in a fine fettle until the pandemic hit. But there is every chance that they will recoup all this over the next few quarters as well. The concept of IPL should work in their favor as well. The online ordering number of stores should work. So yeah, hold this recommendation.
All right, gentlemen. Thanks very much for joining in.